Hi there, Brian Perry, Executive Vice President, Director of Research, Pure Financial Advisors. Today I want to talk to you about inflation. What's going on with inflation? What does it mean for you and your finances? We're getting a lot of questions on the topic lately, so I want to dive on in. And why are we getting questions on it? Well, there's some things going on in the news, some headlines that are causing people to worry about inflation. Among them, we're looking at potentially another couple $1 trillion of stimulus, 1.9 trillion. We're looking at people getting vaccinated, so the economy opening back up. We're looking at trade wars, which means more production comes back to the United States. Maybe we onshore some of those supply chains that we saw disrupted with COVID. All of those things could lead to higher prices, so people worry, what's going on? What's going to happen with inflation? Let's take a little bit of a look at that. For starters, let's acknowledge the fact that things go up over time. In the long run, prices rise. In fact, you're looking at about a 12 or 13-fold increase in your cost of living since the end of World War II. So since the end of World War II, you've seen prices move up significantly. However, the rate of increase has been gradual. And here's where I think the challenge comes in, is that some of you out there might remember the 1970s, early 1980s with really high inflation. People tend to get worried about it. They remember those double-digit inflation levels, 15% mortgage, gas lines, the bad old days of stagflation, and they're always waiting for it to come back. It's like the boogeyman. It's always there under the bed, except you never see it. Let's look at inflation more recently, though. This is the last 25 years. The last 25 years, you haven't seen inflation above 6%. In fact, there's only been a couple times inflation's even been above 4% here in the last 2.5 decades. So again, inflation has been pretty moderate. Couple reasons for that. I mentioned some reasons you could see inflation go higher, right? You're looking at the end of COVID potentially, hopefully, right? You're looking at stimulus from the government, really easy central bank policy. But the flip side of that is that you have globalization still going on, even if it gets scaled back a little, where companies can look around for lower cost of production, pass that along to consumers. You're looking at the internet, which is incredibly deflationary, right? People can shop around for prices, get the lowest price. Let's look at more recently. You've had pretty low inflation here, and this is inflation in the last 12 months, running at about 1.5%, 2%. But what I want to focus on here is there's a couple different bars. There's all items excluding food and energy in green. There's food in light blue and energy in dark blue, because a lot of people say consumer price index doesn't apply to me, and that may or may not be true. It's for general population, doesn't mean it's your specific basket of goods. But then they say, why do they back out food and energy when they look at it? And this is why. Look at the last 12 months. If you're looking at food, price went up a bunch. If you're looking at energy, people couldn't fly or drive, price went down a lot. The truth is somewhere in the middle. So when the government tries to make policy, they want a more stable number so that they can take long-range projections. That's why they look at the consumer price index, X food and energy, because those components are so volatile, right? So what's going to happen with inflation? I wish I knew, right? I wish I knew exactly what was going to happen, but what I can tell you is this. I think it's extremely unlikely you go back to the 1970s, double-digit levels of inflation. I think it's even less likely you get some of these hyperinflation scenarios, like Zimbabwe used to print a $100 trillion note, right? Crazy inflation. Weimar Germany back in the 1930s used to burn bales of money for fuel. There's pictures of kids making kites out of it and stuff like that. I don't think we're going back there. But sure, inflation can move a little bit higher, and if it does, what do you do about it? What impact will that have? Well, a couple areas. One, people worry about the impact of inflation on the dollar, and you see here, long-run dollar trend, a big spike here after the 1970s into the 1980s. Then you had 1987, I believe it was, the Plaza Accords. Countries came together, decided to weaken the dollar. Dollar fell a lot, and since then there's been volatility, sure, but you see a couple of broad trends up here in the 1990s, down again into the 2000s, and then up into the 2010s. Lately, though, dollar has been weakening, right? So how do you protect against a weaker dollar? A weaker dollar doesn't have to be a bad thing as an investor. You globally diversify, right? If you're a US-based investor buying international stocks, a falling dollar is your friend because it increases your returns when you take those foreign dollars and come back and convert them back into US currencies. So global diversification can help protect against a weaker dollar. What else does inflation impact? Well, inflation impacts treasury yields, right? Higher inflation generally leads to higher interest rates. Right? Over time, again, this is something people worry about. You can see the increase in 10-year treasury. Light blue is the absolute rate, the nominal rate. The gray, that's the real rate after inflation. You can see that we peaked here in the early 1980s and been more or less going down ever since. Until recently, right? This is 5 years. or excuse me, 5 years, you see the sharp decline in interest rates heading into COVID. We've more or less tripled in interest rates since COVID, right? We've gone from about 0.5% on the 10-year Treasury to about 1.5%. So a tripling of interest rates, still at really low levels, right? More recently, here's that trend. Here's that increase from 0.5% at the start of the fall to 1.5%, right? So what do you do to protect yourself against rising interest rates is you own reasonably short and intermediate term bonds. The longer you've lent somebody money, the more at risk you are of inflation eating away at your purchasing power. You focus on shorter term bonds, there's less of a risk. You wind up getting your money back quicker. That means that you can reinvest it quicker. That means that if interest rates go higher, that's your friend because you can reinvest those dollars at higher rates. What about alternatives? What if the dollar is going to weaken, there's going to be inflation? What if I go out and buy Bitcoin or something like that, or gold? Well, when we look at Bitcoin and gold, it's important to realize a couple things. One is that these things could have a place in your portfolio. I don't know. But they need to be sized appropriately like any other investment. It shouldn't be all your money or most of your money. It should be a sliver, if at all. The second thing to keep in mind is that neither Bitcoin nor gold pays any kind of cash flow. So when you look at these things, if you look at a stock, bond, real estate, those all have cash flow. You're looking at future cash flow, discounting it back to net present value, right? If you're looking at Bitcoin or gold or something like that, a hard asset, there's no cash flows. You need to price it by determining what you think somebody will pay for it in the future. That's a very different exercise. Now you're trying to evaluate somebody else's psychology down the road as opposed to cash flow. Doesn't make it a good or bad exercise, but does make it different. The other two things I want to point out, one is with Bitcoin. U.S. auto industry, last century plus, 120 years, obviously there's a lot of cars on the road, right? Lots of traffic. It's been successful. There have been about 3,000 car companies in the United States during that time period. Less than a handful of them have survived, and even fewer have thrived throughout that period. So just because I bring that up as a point, because even if digital currencies are here to stay a century from now, they're thriving, everybody's using them, doesn't mean that the early leaders or any one digital currency will be successful. Right now, Bitcoin is the leader, the most successful, doesn't mean it will be. And that's not a pronouncement specifically on Bitcoin, it's just a buyer beware. I don't think digital currencies are necessarily going away. I think the underlying infrastructure behind it is transformational, but you need to be careful and also realize just how volatile these assets are. Then gold. I want to end with gold here. Long run return of gold hasn't been very good. It's been long periods of flat with a couple of big bull markets in the 1970s into the 80s, here in the 2000s, and then again in the last couple years. But if you look over the last decade, the return on gold relatively flat. We find people sometimes that are going to buy gold because, hey, they think the world's going to come to an end, inflation's going to soar, deflation, the US dollar, whatever it is. Keep in mind, you can't eat gold and it's heavy to carry, right? So if the world's coming to an end, you probably don't want to look at gold. You probably want canned goods or something edible, right? Gold can have a place in a portfolio, but again, how much you buy is an open question. Here at Pure, we don't necessarily put clients in gold. We don't, again, because it doesn't produce those cash flows, we're not necessarily believers in non-cash flow producing assets. But for some people, if gold does make sense as a hedge against potentially higher inflation, you want to have a relatively small percentage of your portfolio in that. So the takeaway from all of this, inflation's something to be aware of. It's something to protect your portfolio against, but it's not something to run away from. Sure, it's there, but there are steps you can take to mitigate it. If you try to get too creative, you're probably going to get burned. Focus on the tried and true techniques that have worked for people throughout inflationary environments across time. If you want to learn more about this or anything else, visit us at purefinancial.com. We also have a blog on this topic right now. We've got a ton of educational video content. Or if you want a free financial assessment, we can take a look at what impact inflation might have on your portfolio. We'll take a look at your tax strategy, where you stand from that standpoint. Check us out, purefinancial.com. Free financial assessment if you want it, or reach out to us for more educational content.